All right, good morning, everyone. It is Stuart Williams speaking. I'm the Managing Director of Nikko Asset Management, and welcome to the July webinar. We've got a couple of new faces from ARK joining us today, and their timing is excellent. Mid-earnings season and a couple of days post the Tesla results. So we're going to be joined, first of all, by Grant Banko, who's a client portfolio specialist, and then on to Sam Korus, who is a director of research in autonomous technology and robotics. After that, we're going on to Michael Sherrock and Ian Bellew. So just a couple of things to remind everyone. Remember, the Q&A function is live, and I'll curate any questions if there is time. And for any press that is on the call, remember to contact either Sharon or Jez if you want to use any excerpts of this. So without any further delay, let's go to you, I think. Grant, first up. Thanks and welcome.
Thank you very much, Stuart. I appreciate that. And I will keep my portion brief because Sam actually has the more interesting future robotaxi conversation to share some of our ideas. So I'll just very quickly pull up a slide here. It's quite busy and I won't go through each data point here, but I just wanted to highlight the disruptive innovation strategy, the performance in the first half of this year. It really started back in November with the President Trump election and the results of that election, giving hope that there's going to be deregulation, there's going to be tax cuts, there's going to be a more friendly environment for growth in innovative stocks. And we did see that in the first 2 months of last year and the beginning of this year. There was somewhat of a delay to everyone knows the tariffs and that implementation. Trump first announcing his plan to do reciprocal tariffs back in he said his plan back in February, and that's sort of where you see this drop off here. And then you actually have the actual Liberation Day happening at the end of Q1. So that was definitely a tougher environment as investors were trying to digest what the tariffs actually looked like and how hard of an environment that was actually going to be. Luckily, 3 days later, Trump did announce that 90-day pause and sort of gave more clear timelines of getting deals done. And we've sort of seen some of those trade deals announced and are getting more clarity of what the tariffs are looking like with different countries throughout. So as we gain more clarity on the tariffs and what the deals look like, it does give investors sort of ease in worry, but also to get away from tariffs and stuff around deregulation. A big area of our strategy that has been hit probably the hardest is the multi-omic space. So a lot of those have been beaten down, and we are starting to see deregulation happening in the FDA. So two things I would highlight. In the beginning of April, the FDA actually announced a plan to phase out animal testing requirements for monoclonal antibodies and other drugs. So that should help bring drug discovery faster to the market and help these sort of earlier stage multi-omics companies get products to market. The other big one was the FDA appointing Dr. Vinay Prasad as the FDA CBR, and then Jeremy Walsh as the chief AI officer. So we have seen that they are embracing AI and allowing these drug companies to use AI. And some of the companies have even shown that in drug discovery. So Recursion Pharmaceuticals is a great example. They're actually using AI in their drug discovery process where they can test a drug 15 months sooner and get approval. It can get through phase one 15 months faster than the normal process using AI. So we're starting to see some of those results come through in deregulation and helping these genomics companies. And then on the other side of things, you're seeing the crypto. We just had crypto week and the stablecoin laws passed here. So we're seeing more friendly environment for cryptocurrency, blockchain. And then leading into Sam, towards the end of the quarter, we had Tesla Robotaxi launch in Austin, Texas. We did just have the Tesla results as well come out yesterday, and Sam can definitely dive more into that. But we're seeing more tailwinds for innovation. We're seeing a more friendly regulatory environment. We're starting to get more clarity on tariffs. We just had the tax bill passed as well. So a lot of tailwinds for innovation type stocks, and we believe this is just the beginning. And as we get further into this year and get more clarity on trade deals going, we're pretty optimistic of where these innovation stocks could go. So with that, I will pass it over to Sam to get into Robotaxi.
Thanks, Grant. Yeah, so we're going to cover all things autonomous tech and robotics. So EVs, autonomous cars, will go into energy, other autonomous objects like drones and delivery, and then into space. But to kick it all off, on the robo taxi and EV side, it's becoming increasingly clear that electric vehicles are the future. And I mean, it's very clear in China, it's very clear in parts of Europe. The US is behind, but if you take a step back and you look at the aggregate, uh, the internal combustion engine is dying and has been dying for close to a decade now. And the trend that we're seeing is, people are going to hybrid instead of pure internal combustion engine, and then people go to battery electric. And in geographies where battery electric is already less expensive than the hybrid and internal combustion engine, then there's rapid adoption over. And so we expect this to continue. Battery costs, which are driving this, continue to fall. That really was the biggest bottleneck. And now, there's certainly hiccups along the way with tariffs and nationalism and deglobalization. But the trend throughout all of this is continuing its upward tick. So that's kind of the foundation for the belief and really the research that drives a all electric future. Then Grant, if we go to the next slide, we also think, right, first electric, then electric autonomous. And a lot of people like to point to Tesla and say, oh, they keep pushing it out, keep pushing it out. Um, just because someone's still in the race, I would say it would be foolish to chastise someone who's still making progress when everyone else claimed that they would have autonomous vehicles, but realizing the task ahead, quit halfway down the line. We're somewhat seeing that too with the shift to electric. And so I do think there's going to be real consolidation as we shift over from human driven and petrol to autonomous electric. Here, we can get into, I'm sure everyone wants to know, Waymo versus Tesla, and we can get into that. It is interesting that Waymo commercialized Robotaxi in 2018. It's now 7 years later. They have a fleet of 1,500 vehicles, and they are expanding that by 2,000 vehicles through the end of 2026. So, certainly, if you look right now, they are the leader because they have fully autonomous operations. And this is actually great proof of concept. Mary Meeker released a deck showing that in San Francisco, people are taking Waymo and it's taking share from Uber and Lyft, the ride hail services, despite being more expensive. So this suggests that as Tesla ramps and scales and offers a product that is less expensive, there should be a dramatic share shift. And then again, for context, Waymo, 1,500 vehicles over 7 years, hoping to add 2,000 through the end of next year. Tesla manufactures 5,000 cars a day. So I think it's easy to take a snapshot right now and say, oh, look, Google's way ahead. But if you look at velocity, it's not even close. Next slide, Grant. Yeah, so I see some questions coming in, so I'll answer those as I go as well. So the reason we didn't include Chinese automakers in this is uh, for autonomous, actually, the opportunity is much bigger outside of China just because the main cost of a human-driven ride hail is the human. And in China, the drivers do not get paid a lot of money. So stripping the driver out is less great of a magnitude than, say, in the US or Europe or other geographies. That's not to say, I think it's a great point. I think in this year's we'll certainly include China. They're doing great things. We see Baidu, we see Pony AI, and certainly track them as well. So why is autonomous so important, so foundational, and so transformative? For the past 100 years, inflation adjusted, it's pretty much cost the exact same amount of money to take a personal car. And this is really the first time that there's going to be a step function change. And this is going to induce a ton of demand and likely change the way cities are populated, the way people travel. Um, Really, I think will change day-to-day life. This goes back to the, Tesla versus Waymo. At the end of the day, the most important thing for robotaxi, obviously safety. That's what we think is necessary. Yeah, it's necessary, but it's not really going to win the market. No one's choosing one versus the other, planes right now based on which one's marginally safer. I think all of these are going to be far safer than human drivers. I mean, already that is the case. You can look at the Waymo data, you can look at the Tesla data. Neither of these cars are teenagers looking at their cell phones going 70 miles an hour, and that's a good thing. So what is it going to be at the end of the day? Price per mile. And we're already seeing that today. There's a winner take most, even in human driven ride hail. And still, it's like I have both apps. Whenever I need to go somewhere, I open both, and whichever one's cheaper, as long as they're both relatively similar wait times, then that's the one you take. And a huge difference here is the cost of the vehicle. So Tesla's manufacturing capability and decision to go vision only is a fundamentally cheaper vehicle than what Waymo is going for with LiDAR. And the fact that, Tesla can have these cars be part of their own fleet or have third party people add to the fleet really changes the dynamic when you have to meet peak trough demand. So, people go to work all at the same time. You don't want to have a fleet that is capable of meeting that and then underutilized. Otherwise, your prices go up. And at the same time, if you have a small fleet and you can't meet peak demand, no one's going to open your app because if they need to during rush hour, it's going to tell them, 30 minutes to get a car. So that's another key element of Tesla's advantage there. Next slide, Grant. This, this is great work from Tasha Keeney on our team, and this is kind of showing the supply curve here of how big this market can get to 10 trillion as prices come down. And so you can see on the very left here, there's $134 billion opportunity, and that's just coming in at the price of rideshare today in Western markets. So that's the $2 to $4 per mile. As you lower the cost, you can access a much greater uh, portion of vehicle miles traveled. And we think that at scale, robotaxi gets all the way down to 25 cents per mile. And then you really, really open up the size of this market. Next slide. I see. Okay. Thoughts on Musk boycott versus sales and robotaxi growth trajectory. So just very high level here, we open source our Tesla valuation. We have a $2,600 price target for 2029, and 90% of that enterprise value is driven by robotaxi. So we do think this is a fundamental transition. I think Elon is right. There could be volatility in this near term, but once robotaxi starts to scale, the EV business is dwarfed quite rapidly. And it does appear that, Elon and team are leaning into the capabilities that they have and believe that the time for robotaxi is now. Then this is going on beyond just things that drive. This is the exciting logistics side. Autonomous cars for people is great. It's also going to transform the trucking industry, right? You get massive cost savings there. You get smaller form factors as well. These have taken off on a lot of college campuses. These essentially coolers on wheels that deliver pizza at whatever time of night you want. Massive cost saving relative to a human delivering that. And then a very exciting one. You can see this is actually the greatest cost savings here is drone delivery. And we're starting to get more and more regulations that allow for beyond line of sight. So this was something that was holding it back because actually an autonomous drone is far easier to do than a vehicle. There are fewer things to hit, less traffic. And so if we go to the next slide, you can see that this drone delivery is really taking off with Zipline being the key leader here. A lot of deliveries on the medical front. We're starting to see things being launched in the US with Walmart and some other partners. Amazon's here. Wing from Alphabet is doing this. This is, China, Meituan has this, and in China, it's pretty pervasive in certain areas. And so we think this is, going to probably change shopping behavior to the same extent that autonomous is going to change travel behavior. You don't need to necessarily go to the grocery store and load up if you can say, okay, I need, carrots, chicken. I don't know what I'm making here, chicken soup, some parsley, and have it drone delivered to you. Uh, we can go to the next slide. And then, of course, the autonomous drone side that everyone's been talking about recently as these global conflicts continue is on the defense side. Um, you know, Ukraine, Red Sea, in Israel and Iran as well. We just see that low cost drones are really transforming how war is fought. If you can have a $2,000 drone take out a $50 million fighter jet, then that's a pretty asymmetric attack. And so there's been huge investments in all sorts of drones, from the Chinese drones, quadcopters, to much more sophisticated interceptors. And I think this is really just the beginning here. We're seeing tons of company creation and innovation. And on the flip side of it, we're also seeing the counter drone boom as well, and companies forming and investing on that front. And it's likely a arms race there as well. Next slide. All right, we went through all things autonomous. Now the energy side. Uh, Energy is critical to the future, and at ARK, we really believe more energy is better. And there's a lot of people who say, if you're going to be socially conscious, actually less energy is better. And we would fundamentally disagree with that. The more energy you build, the faster you will go to the lowest cost form of electricity, and the lowest cost forms of electricity are all renewable. So that's nuclear, solar, wind, those plus batteries added in there. It's like if we are choosing the path of growth, you need it, and that will be what fuels it. There's been a lot of talk about AI and what it means for changing the curve of the energy we need. Um, if you look in North America uh, at the amount of energy we need, it's actually less. And this is our forecast, and we're known for having aggressive forecasts. In 2030, the amount of incremental power we would need for all the AI investments that are happening is less than what China added in 2023. So it's a large amount, but it's certainly possible if we choose to, remove some red tape and truly build. And you can see on the left, it's incremental, right? It's certainly a slope up in the curve relative to the trailing 5-year forecast there, which is the green line. And the red line is what we would need. But this is certainly possible, and we're getting lots of investment going into this area. So it should be possible to achieve. Next slide. Nuclear is a big topic of conversation. I'll go through this quickly. In the US, electricity prices have been consistently declining since the late 1800s until 1974. What happened in 1974? Well, that was when the US created legislation that made it extremely onerous to build any nuclear. And you see at that point in time on the chart on the right, uh, costs for building nuclear increased. Had this not been the case, we would have continued cost declines for electricity. And it seems like the US is trying to right that wrong. Even Europe, who swung against, and Japan, who swung against it after, Fukushima, has reverted back, and everyone kind of sees the value of investing in nuclear again. Next slide. Yeah, so it's like one of the surprising things people learn is that the cheapest form of electricity really we've ever had has been nuclear way back when. And it's like solar came along and got close to it. But if we could essentially just take what we used to do 50 to 70 years ago and recreate it today, without having to go through crazy amounts of regulation and NIMBYism, we should be able to produce crazy amount of electricity for an extremely low cost. And so on the right, you can see the overnight capital cost. Nuclear has the potential to be the lowest capital cost. And unlike solar, it has an extremely high capacity factor. So instead of, generating electricity, 20 to 25% of the time, it's typically producing electricity 90% of the time. Next slide. Hasn't Trump just killed renewable expansion? Oh, sorry, Stuart, you're going to answer that live. We'll come back to it. So we're getting to this. Nuclear is on a runaway path. This isn't to say that nuclear is going to stop solar or batteries. And you can see they're consistently growing. China, more so than anyone else, is rapidly building out solar. There have certainly been hurdles put in place in the US, but I think people are still going to do it because the economics will still make sense as long as you can bring it online in a reasonable time frame. And typically, you know, when we're doing all of this modeling, we don't take into account political incentives or incentives in general because we've seen these snap back and forth quite rapidly depending on who's in office. Next slide. All right, onto the robotics side. Humanoid robots and robotics plus AI in general are going to change how people work, and they're going to change the home, right? We've been talking to a lot of companies entering both the industrial space and looking to uh, help people at home. At home, all of us spend roughly 2 hours a day doing things that we probably don't like to do, like cleaning, folding, laundry, dishes, cooking. Some people like to cook. We'll give them that one. But if you multiply this by the population and the weighted average hourly wage, and we're going to say that people value their free time at half their paid time, and there's some studies to back this up. There's a $13 trillion opportunity if you have a household robot that can clear the dishes off your table and put them into another robot called the dishwasher. And then same thing if they can take your hamper, unload it into another robot called the washing machine, and take it out, put it into the other robot you already own, the dryer, and then fold it. This is a huge opportunity. And on the manufacturing side, again, there's tons of low-hanging fruit here, and the productivity uplift from robotics that we've seen deployed already are quite high. And so if the robots just take a small, 20% take rate, you can see, this could be anywhere from a 3 to $13 trillion opportunity if they take a higher take rate, which we can get to on the next slide. We think these opportunities are roughly equal. And so why are robots so appealing? Robots are so appealing from an economic standpoint because humans are so expensive. So, the average human labor cost in the US over 10 years is like $550,000. And that doesn't include the cost of turnover, which is quite significant, especially in some of these retail roles where you have more than 100% turnover per year. And so the question isn't, can you build a robot for $550,000? 100% that's possible, right? It's like you could hand make a robot for that much. The question is, what will the capability be, and how many tasks can it take over such that it becomes worth it? Because, if it could do everything a human could do, you would pay $550,000, if not more. Likely where this is going to start, if we look on this chart to the right, is in the bottom left corner, right? You get a robot and it's like maybe it doesn't do tons of useful things, and so you're not willing to pay so much for it. But the productivity uplift is going to continue to increase at a rapid rate. And I think, you know, so far there's been no plateau in AI capability, and we haven't really truly embodied AI yet. And so, that should be very fertile ground for new innovations and continued progress. Next slide. And this is just to show, I think robots are very interesting because it's extremely hard to do a full job, but it's extremely easy to do a single task. And single tasks are huge opportunities. And so it's important to really distinguish between the task and the job. And so this is just looking at the US. One of the most successful robots ever is the dishwasher. And yet we pay dishwashers, professional dishwashers, about twice as much as people spend on dishwashing robots each year. And what's the job of a professional dishwasher? Well, really only one of 13 tasks is to wash dishes. And then they're doing all different things. And so if you had a robot that could just load the dishwasher and unload it appropriately, if you take the value of that time, that's a $246 billion opportunity annually, right? So that's transformative and a single task to do, but it's not a job replacement, right? It's like there's still all these other things that would need to be done. And so, I think people overestimate the ability of a robot to truly do someone's job and underestimate how quickly it will start to do some of these tasks and how valuable those tasks are. Next slide. And then this is I love this. Anytime you mention robots, people say, what about our jobs? They're going to take our jobs. Really, the burden of proof on that, we would say, is on the people saying that robots are going to steal jobs. Technological unemployment has never happened. And um, and what typically happens is you take non-market activity and you bring it into the market. So when tractors came around and you destroyed close to 7 million jobs, uh, over 80% of those people who lost jobs were family farm workers who were forced to help their parents so that they could make a living. And what did they do? They went into cities and created civilization as we know it today. Next slide. All right, space. I think this is the last one, so we're wrapping up. Reusable rockets fundamentally changing space, opened up low Earth orbit. SpaceX has a crazy lead here, 10 years ahead of everyone else. When they first did it, everyone said, we tried this, it didn't work, you're dumb. And now, 10 years later, it seems like everyone else has woken up, and you have Blue Origin, Rocket Lab, Chinese companies, Stoke Space, Firefly, Relativity, all these companies that are aiming to do reusable rockets. Next slide. And what does this allow, right? It allows this Wright's law cost decline curve to continue. And so this is a crazy thing to realize. And this is the cost of bandwidth in orbit. So think Starlink. And originally back in 2004, when they when they did this, it was $300 million per gigabit per second in space. SpaceX has brought that all the way down to $20,000. And as it continues, it's going to drop down to $1,000 per gigabit per second, which means that you could recoup the Starship, so the rocket plus the satellite investment, with a one-time charge of around $5 per customer per year. So, people think the world is connected today. I say people don't appreciate that if you go forward 10 years from now, you'll look back and you'll be like, wow, I can't believe people thought that the world was connected. I think that's it.
That's awesome. Thanks, guys. Thanks, Sam. Hey, I will just ask one question, even though we're pretty much on time, and it's related to the question you could see off to the side. Um, I guess people were interested in potentially Trump winding back some of the renewable energy, or incentives for sure via the IRA Act. But my question is actually more about what you were talking about for nuclear. Is there bipartisan support for nuclear development, given hopefully everyone's figured out you need a lot more energy in the US? So if you and also I guess the time to develop and build nuclear, even small cell nuclear.
Yes, there's certainly bipartisan support. I think we just saw it in the last day or so, multiple people coming out realizing, the AI race is on. How do you fuel the AI race? Well, you need compute, and how do you make sure that compute's only good if you can turn it on? And so you need power. So there is certainly support there. There's certainly, it's like you can't ignore that removing some of these incentives for solar is, I think, net negative. Um, at the same time, we always say truth wins out, and the economics are going to show themselves. It's probably going to take longer than we would hope. And same thing with electric vehicles in the US, right? If everyone was a rational actor, then people would be building more electric vehicles and more consumers would be buying them. But the US is lagging the rest of the world there.
Awesome. We are just a tad over time. I've got a question offline which we might fire through to you and send to that person. But hey, it was great to meet you both, following on from Tash a couple of sessions ago. So it's good to meet more of the ARK team. I will leave you to get on with the rest of your day or evening, I guess. And thanks very much, and we'll see you in person hopefully soon.
Would love to
Thank you
come
very
visit.
much.
Great. Very good. Hey, we are going to move on to my colleague, Michael Sherrock, who's talking about Australasian equities. So, Michael, over to you.
Great, thanks, Stu. Good morning, everyone. Happy Friday. Look, this is my first week back after taking a couple of weeks of leave. I spent most of that in the Gold Coast, and I can certainly understand why we're seeing the strongest migration to Australia from New Zealand in around 13 years. So we had a net 30,000 New Zealanders leave for Australia in 2024. The weather was stunning while I was over there. Not a cloud in the sky. Temperatures 20 to 22 degrees. And on top of the good weather, arguably the job prospects and pay are better there as well. So, something for corporates in New Zealand to contend with, and just think about some of the risks of losing skilled staff over to Australia, and also the public sector as well. That's something to think about. And everywhere that I went was busy. The theme parks were packed, the lines were massive, the restaurants were busy, and also a fair bit of construction going on in the Gold Coast as well. So that was all good. And from what I understand, over that 2 week period, the weather was pretty rubbish in New Zealand, albeit it has picked up a little bit over this week, albeit probably 10 degrees cooler than Australia. Not all roses, I guess, in Australia. Anything that moves is able to kill you. You got spiders and snakes and crocodiles and jellyfish and so on. So it's not all one way. But just in terms of company updates, over July, we had Fletcher Building update the market. So they're putting out quarterly volume numbers now, something they haven't done in the past, but something that they'll be doing going forward, which provides good visibility for investors as to how the business is going. The key product sales volumes continue to highlight pretty challenging conditions in New Zealand and Australia, albeit New Zealand starting to find a bit of a base, but challenging, and numbers down pretty materially from where they were 12 months ago. And also Fletcher's reiterated a comment they made at their investor day about a month ago, that they don't anticipate any meaningful recovery until FY27. So, we're talking 12 months away. But those quarterly numbers will provide some insight as we go through the year as to how things are tracking and how the business is recovering, and the economy, given they're a bit of a bellwether for what's going on in the construction market. Also, Fletcher's announced, I think it was last Friday now, the progress around the sale of its construction business. They updated the market probably about a month ago as well now, that they'd seen or had some inbound interest in the construction business. So they're just progressing the sale of that. They've appointed financial advisors. There's no certainty that anything will occur there, but just something for us to follow and see what price they might attain for that part of their business. We had Sky TV. They made a reasonably major announcement on Monday. No, it wasn't the rugby right deal that everyone's waiting to hear an update on. It was the acquisition of the Discovery business, so the 3 and the 3Now businesses, and the acquisition price was $1. So that's on a cash-free and debt-free basis. Normally, when businesses transact at very low values, there's a lot of liabilities attached. Thinking about something like Torpedo 7, which sold for $1, but also had lots of liabilities, lots of lease liabilities attached. That's not the case here. Sky TV is picking this business up with no liabilities, and in fact, a portfolio of content rights as well. So that will provide them about 12 to 18 months of content that they can continue to put through the 3 brands over the next little while, and is costing them nothing. So that's great. And also, Sky TV is expecting the deal to be cash flow positive in the first year, and by FY28 we'll be adding around $10 million, and they're very confident around the $10 million. There's potential for upside, $10 million of earnings to the business. So. Look, on the face of it, for $1, it's worked out to be a pretty good transaction for Sky. And probably one of the important things as well in the release was that they reiterated that they are still very confident on delivering a 30 cents per share dividend in FY26. So, that's the financial year that we're in right now. So if we think about 30 cents versus where the stock's trading at $3.10, it's a very attractive yield of around 10%. So, that's great. And that transaction is expected to complete next Friday, so the 1st of August. So it's not one of those long, drawn-out processes. It will be done and dusted very quickly, so that's great. On the retail side of things, retail continues to be very tough. We saw Warehouse come out at the start of July. They downgraded their earnings, so they're now expecting their earnings for the year to be a $5 million loss to a $5 million gain within that range. A warm winter is what they're saying has impacted sales, and they've had to cut prices, so margins impacted. So that discounting of stock just to get things moving, really having a big impact on them. So that guidance implies that the second half earnings is going to be about a $20 million loss. So pretty tough times. Warehouse less relevant to the market now. It has moved out of the NZX 50, and so it's was once a very strong business. It's fallen by the wayside to some degree. On the retirement side of things, we had both Somerset and Ryman provide better than expected sales updates, and so both appearing to benefit from a stabilisation in the property market. We had the Real Estate Institute of New Zealand come out with their June update during July, showing a stable prices and also sales volumes up, pretty materially from where they were last year, albeit pretty depressed last year. So volumes up around 20% year on year. And what has that meant for the retirement names? Somerset announced a record June sales number, and that flowed through to their first half sales numbers, which are up about 18% on where they were the same period last year. So a very positive update from them. And Ryman, they had their June quarter sales out. It's something that they haven't done in the past. They will continue with regular updates to the market in terms of sales numbers. And that was of great interest to the market given disappointing updates over recent times. But pleasingly, sales and contracts were better than expected. And sales, while down versus the same period last year, have improved sequentially. So versus March, the March quarter, the sales numbers have improved. and also the contracting of units has improved as well, which provides certainty around what things might look like in the next little while as those contracts turn into sales. So while only one quarter into the financial year, Ryman has actually come out and said that they're tracking towards the upper end of their previous guidance of around 1,100 to 1,300 unit sales over the year. That guidance was only given around about a month ago at their result, really indicating that Ryman is being very, very conservative in terms of what they're putting out to the market. They're wanting to make sure that they hit anything that they put out into the market, given I guess the missteps that they've had over recent times. Both stocks have performed reasonably well on the back of those updates. Somerset up a touch over 3% month to date, and Ryman up around 12% month to date as well. So, and that follows on from a near 7% June return for Ryman, albeit a lot of work still to do given the fall they had in the first quarter of the calendar year. Ryman has also appointed a new CFO, and so we had the opportunity to get in front of him during the month as well. Always good to get in front of corporates. He seems like a pretty safe pair of hands with good experience. So we'll continue to follow that. And we also had a separate meeting with two of the Ryman directors during the period as well. So just good face time with the company. On tariffs, look, that's just a never-ending story, a moving feast. You never know what is coming out of the US day to day. Is it a deal with Europe? Is it Mexican goods at 30%? Yesterday they indicated that the lowest tariff rate would be 15%. Everyone thought that was going to be 10%. Certainly that's what they had said previously. We'll continue to monitor everything around that, but from listed New Zealand market and also from a country point of view, pretty limited impacts. What we do export to the US, can pretty easily find other markets to send those goods to. And as I say, pretty limited impacts across the listed market and where we're investing. Just looking ahead to August, we have a reporting season for the companies that have June period ends. There's nearly 30 of the NZX 50 that will have results out, so very busy time. The gentailers, a chunk of that, the Contacts, Mercuries, Meridians, but we shouldn't expect any major surprises out of them, given they provide regular operating stats. The stock that will get a lot of attention will be Spark, just given the series of disappointing results that they've had, and also the market will be looking forward to any update that they can provide around capital partners for their data center business. Probably more importantly will be the outlook statements that companies have. How are things tracking? What do they see in the next 6 and 12 months? Are there any green shoots that might provide optimism for investors to upgrade their earnings expectations over the next little while? So that'll be one of the key focuses. And I'm just going to quickly share one screen. Bear with me as I bring this up. Let's make that full screen there. Hopefully that comes through now. Look, this is just the top 10 stocks in our core fund, our top 10 overweights. On the right-hand side of this, you can see the forecast returns. So that's based on consensus sell-side target prices. So the broker analysts, the average of those, pretty much we will be somewhere around what those target prices are. Plus the dividend yields provides that forecast return. And so pretty healthy outlooks or return opportunities in those top 10 overweights in our core fund. We don't necessarily agree with everything that's there. Something like Sky TV, there's a bit of a rogue number there from one of the Aussie analysts that has it valued at $2. If we exclude that, the target price would be around $3.50. And that dividend yield of 7% showing there. If we roll forward to the 30 cents, that's somewhere near 10%. And the other one that's sort of on the lower side of things is Kiwi Property. We have a higher view on valuation, and outside of that, anyway, you get a near 6% after-tax yield. Just holding that at the moment, anyway. So I'll just leave that there on the screen, and then just talk through our underweights. So our largest underweights in the portfolio at the moment in the core fund at least anyway, Goodman Property Precinct, Mercury, Genesis, and Freightways. You'll note that there's 2 property names there. We've been adding property exposure to the portfolio with the view that lower rates will be supportive of property valuations and also attractive yields on offer. And you can see Kiwi Property Trust, one of the top 10 overweights now. That was a nil holding a few months ago, and also adding a little bit to Stride and some of the Australian real estate names. Just rounding out in terms of market returns for the month to date, the NZX 50 is up about 1.6% at the moment, and our core and SRI funds are around 10 to 15 basis points ahead of that. Concentrated fund up about 2.5% month to date, so that's pleasing. And property is having a good run as well, up about 4.6% and a touch ahead of the property index. I'll just stop sharing that screen there and just pass back to Stu, see if there's questions or any time for questions.
I think you're right on time, Michael. And you've covered a lot of good stuff. So thanks very much. When you said you're going to share the screen, I was thinking there was some sort of holiday shot coming from Fun Parks, and I was thinking, man, I hope you've got the right.
No time shots. No.
Okay, yeah, that's good. With that nice handle, we'll go to the fixed interest team. So welcome, Ian Bellew. The time's all yours. And again, if you've got questions for Ian, then type them in and we'll deal with them, or we'll come back to you afterwards. Over to you, Ian. Thank you.
Thank you, Stu, and good morning, everyone. I'll just start with a brief update on the funds. So month to date, interest rates are fairly much unchanged. The 2 main funds, the bond fund and the corporate bond fund, are up around about 20 to 30 basis points, slightly ahead of index, but we've still got a few days to go yet. This morning, I thought I'd cover off, what I think the main drivers or themes are in markets at more high level, because quite often we get tied up in the the minutiae and the volatility. Certainly we've been in highly uncertain times, but we are seeing some improvement, I guess, with Trump actually securing some trade deals, and I guess what really matters in New Zealand in terms of uncertainty is how that impacts consumers and businesses. So consumers are obviously most concerned about stability of their employment going forward, and obviously businesses about the profitability of their businesses as well. And before the tariff announcements, there were tentative signs that the New Zealand economy was improving, but unfortunately we've seen that sort of fall into a slump or go backwards in terms of the high frequency readings we've been having on the economy. So some of the themes that we think are important going forward, we prefer to focus on the things that we think are most likely to add value to the portfolio. In New Zealand, we have one of the steepest yield curves in the world. So generally, when we talk about the slope of the yield curve, we talk about the gap between a 2-year swap rates and 10-year swap rates. So that's about 1%. So the curve is steeply positively shaped. So you are getting significantly rewarded for buying bonds longer in maturity. So the underlying yield curve is very steep, and also you get a larger credit margin for investing for longer as well. So you can see that expressed in both our bond portfolios. A corporate bond portfolio has a duration of around about 4.1 years. It's a bit over 1 year longer than its benchmark. And the main bond portfolio also is about 1 year longer in duration than benchmark as well. And the yield on the corporate portfolio is around about 4.6% and around about 4.5% on the main bond portfolio. Also, another significant theme in our markets, of course, has been, the bifurcation between government bond valuations or prices and everything else, corporates, local authorities, etc. So it's probably the most significant impact we've ever seen from, supply as a factor driving price. So it's not just the case in New Zealand, but in the rest of the world, there's been obviously quite a surplus of government supply. So markets have been very focused on any fiscal expansion. So in the US, I've had the big beautiful bill. In Europe, we're getting, greater fiscal spend going forward to fund defence spending. And in Japan, the Bank of Japan is reducing its amount, its buying of JGB's government bonds at the same time that the economy is reflating. So essentially, we don't think those offshore influences or pressures on the shape of the yield curve, which is causing long-term rates to be higher than short-term rates, is going to go away anytime soon. But what we think is that we're coming to a period where interest rates are going to be in a relatively contained range. So even though markets have been volatile, we look back over the last 3 months, they've been volatile in a relatively moderate range. Part of that may be because the market is, I guess, starting to get some uncertainty fatigue. It's not really reacting the same in terms of up or down movements. And that makes sense. Look, it's rather than chasing volatility, it makes more sense to look at what do you think is most likely to occur in the medium to long term and position your portfolio in regards to that. So that's probably one of our key themes in our bond portfolio, is we think there's better value out the long end of the yield curve. In terms of the short end of the yield curve, obviously there's been a lot of commentary on that recently. The Reserve Bank does have an easing bias, but at the same time, there's some uncertainty around the timing of future rate cuts in New Zealand. Arguably we're very close to reaching a terminal low of the cash rate. So we're currently at 3.25. Most commentators think we're going to go somewhere to 2.75 to try and engender some improvement in the economy. That's been quite challenging, I guess, when the government has been relatively fiscally constrained. Also, at the same time, the Reserve Bank has to have confidence that inflation is going to be under control. So just in the last few days, we've had Q2 inflation come out. It did increase, so it was up 0.5% for the quarter, and then it's at 2.7% annually. So it's a bit closer to the top of the 3% band. But the Reserve Bank expected there was going to be some one-offs, i.e. food prices and energy, that was going to push us a little bit higher. But looking forward to the medium term, they're confident that given the amount of spare capacity or slack in the economy, i.e. the economy being so weak, then inflation is going to move lower over 2026 to the middle of the band, around that sort of 2%. So that does give them confidence and the ability to lower rates further. Of course, one of the main, I guess, transformation mechanisms really is how to underlying rates flow through to mortgages. Look, our thoughts are that mortgages probably aren't really going to go a lot lower. Maybe we'll see some competition among the banks, but mortgage rates are around about 5% as the lows at the moment to 5.5 further out the yield curve. Possibly you get another 20 to maybe 50 basis points lower, but we would need the economy to continue to print weak data for that to happen, and also an underlying expectation that cash rates were going to stay low for quite some time. And that probably is a base case view at the moment, is that there's going to be a gradual grinding recovery, and so regardless of how much further rates are cut, they're probably going to stay there for some time. And we think also that adds support to buying longer term bonds, because people are going to look at the front end, the cash rate, sub 3%, and then look out at bonds, sort of 7-10 years longer, and those yields are going to look a lot more attractive. Also, in terms of supply, it's everything else beside governments has obviously been quite the opposite in terms of supply. So year to date, we've seen around about a 50% reduction in the supply of bonds to market. And also a lot of the issuance that's come to market has been 3-year or floating. So the actual shortage is probably a bit more profound than just the stats at a high level. And you can look to the most recent deals in support of that. So back in February, ANZ issued a 5-year bank bond that was issued at a margin of 95 basis points. Today in secondary market, it's trading around 70 to 75 basis points, which is actually tighter than yields were back before the tariff announcements, following the tariff announcements, there was a bit of a risk-off move, and credit margins did actually expand, move wider in New Zealand, around about 10 or 15 basis points. But they've taken that expansion back plus some as well. On a positive note, here, credit margins are still around 10 basis points wider than levels in Australia for similar securities. Also, just the other day, we saw Transpower issue a 5-year bond. It was a very small deal. It was only around 100 million, but arguably that printed about 10 or 15 basis points tighter in credit margin than what it would have done a month ago. And people who bid into the deal, they only finished up with less than 20% of what they bid for. So again, that just shows just how much of a shortage of supply there is in the New Zealand market. So even though credit spreads are, arguably tight, compared to, I guess, historic norms, we do think that those credit margins will be, continued to be supported just based on, those supply-demand dynamics. So, in terms of building a higher yield on the fund, we do still recommend, buying high-quality credit, although we prefer to invest further out the yield curve. And as I said, the yield on bond funds is around about 4.5%. That Transpower deal was issued at 4.2%. The yield on the cash fund is 3.8%. So, look, I think rates are going lower, but that's largely priced into expectations. We're going to see short-term yields somewhere around that 3%. A 10-year government bond is 4.5%. And also those government bond spreads are very high and wide in comparison to swap. But one positive is, despite the fact there's been a lot of government bond issuance in New Zealand, there's actually been very strong demand from offshore. So recently the government bond, the DMO did a tender or syndication of government bonds, a large deal of about 6 billion. And again, that was very strongly supported by offshore, with over half the deal going to offshore purchases. In terms of the economy, look, I think it's not unusual for New Zealand to have a two-speed economy. So sectors like exports, agriculture is going very well, in terms of trade. And again, the problem is, that's not really flowing through to the rest of the economy. That's just because of the uncertainty or that conservative nature of people, they're repaying debt rather than spending. So I think, look, fundamentally to engender a recovery in the economy, and confidence needs to be improved. People need to feel more secure about their job prospects and profitability of businesses going forward, to get out and spend, and also we're going to have to see that change before people come to markets to borrow as well. And I'll just stop there.
Thanks, Ian. That's an awesome update. Really comprehensive. Hey, just a question that occurred to me. So for people online, bond team's been talking quite a lot about. Obviously, Chairman Powell's under a lot of pressure from President Trump and the potential for a dovish appointee to come. Just makes me think about, is there any update for the New Zealand Reserve Bank governor appointment? I don't know why, but we haven't spoken about that just recently, and we must be getting on for a fair few months through the process now. Anything to add on that front?
So just this week, we saw that someone from the Bank of Canada throwing their hat into the ring, but there's no further updates as to who the likely successful candidate will be. But as I said, the Reserve Bank is fairly close to the end of their easing cycle, so they're almost sort of I guess a paint by numbers sort of track at the moment, and obviously monetary policy has a lag, so some of that stimulus is still to flow through to the economy. Like I guess we're not at a turning point in terms of what the Reserve Bank is doing. It's sort of a well I guess forecast path. But governments do, I guess, have their preferences. They often get characterised as being hawkish or dovish. So it'd be interesting to see who the candidate is and what their views are.
Excellent. Thank you very much. Hey, you've got us done right on time. So thank you very much to all the speakers. Thanks to you, Ian, everyone online. If you've got any questions or follow-ups, and there is a couple of questions off to the side that I need to deal with as well. Just thank you for dialing in, and wishing you a good Friday, and I hope you're all well. Thank you. Goodbye.